Hello and welcome to the Tax Roundup for June 2014. And before we get underway, let's have a quick look at what's going to change from 1 July. For individuals, the temporary budget repair levy or the debt tax adds 2% to the tax rate for every dollar of a taxpayer's annual taxable income above $180,000. There's the increase in the Medicare levy to 2%. The superannuation guarantee increases to 9.5%. Aged care reforms introduce new assets tests for residents, accommodation and care fees. For business, the R&D incentive be reduced. Now this is a budget initiative and it's still pending legislation. The living away from home allowance transitional period ends at the end of this month. Also, the thin capitalisation rules change from 1 July, but that's also pending legislation. For self-managed super funds, there's new trustee penalties. There's also a change in the concessional and non-concessional contribution caps, and also the rules around insurance inside an SMSF change. So if you've got a new insurance policy within an SMSF, it's got to be consistent with a death, terminal illness and permanent and temporary incapacity conditions that are in SIS. From government this month, of course, the big news is the debt tax. It may be the only piece of legislation from the budget that actually makes it through Parliament. Now, the enabling legislation has passed the House of Representatives and it's currently sitting with the Senate Economics Legislation Committee. They're due to report on the 16th of June. To explain the impact of the debt tax and also what you can do to plan around it, Mike Carruthers explains.
Well, probably the main tax item to come out of this year's federal budget was the 2% debt levy. There's been a lot of talk about it already in terms of when will it apply from and what can you do to possibly get around it, mitigate the effect of it. So I thought we'd just give you a bit of a quick update on where things are at. Now, the first thing is that the bills to introduce that debt levy have been introduced into Parliament. They passed the House of Representatives without any problem. Currently sitting with the Senate and are currently with an Economics Committee. That committee is meant to report back mid-June. Depending on what they have to say, we might see the debt levy pass through Parliament pretty soon thereafter. The way the rules are intended to apply is that 2% additional tax rate will apply to individuals with taxable income over $180,000 from the 1st of July 2014 onwards, and that will run for 3 income years. At the end of the 3 income years, it will disappear. There are a lot of flow-on impacts of that debt tax as well. Things like when trustees pay tax either on behalf of an individual or on the assumption that that trustee is taxed like an individual, so where a trust doesn't distribute all its income, for example, the higher rate will apply then. The other one to keep a close eye out for is unearned income of minors. Again, the 2% extra tax rate will apply to all of the unearned income of a minor once they breach that $416 tax-free threshold. So it's quite a big impact of that debt tax on a number of different taxpayers, not just high income earning individuals. The other area that will be changed is the FBT rate, and we'll see from the next FBT year the 2% increase in the FBT rate as well. What that leaves us with is about a 9-month period where we've got the debt levy applying at the individual level, but not being picked up with the FBT rate. So it does open up a significant tax planning opportunity for those who might otherwise be hit with that 2% additional levy. They've got 9 months to salary sacrifice income into non-cash benefits and potentially manage their total tax impact in that way. A similar opportunity will come up at the end of the 3 years. There'll be a 3-month window where the FBT rate drops back to 47%, whereas the total top marginal rate, including Medicare levy and the debt levy, will still be 49%. So there is some tax planning opportunities potentially for many of our clients. It's a matter of having those discussions over the coming months to figure out what the likely impact will be and what opportunities there might be for planning to mitigate around the tax that will be imposed from 1 July 2014.
Also this month, Treasury has released an exposure draft on significant changes to the thin capitalisation rules. Mike Carruthers explains the impact to businesses, big and small.
Now, the government has confirmed over the last few months their plans to go ahead with the proposed changes to the thin capitalisation rules. And from an SME point of view, this is a really positive thing for a lot of our clients. The major impact particularly for SMEs, will be the increase in the de minimis threshold. Right at the moment, you don't really have to worry about the thin cap rules if your total debt deductions, so interest and other debt-related deductions, is below $250,000 a year. However, the proposed changes will increase that threshold to $2 million a year. So that's the actual interest deductions, not the debt, the loans, but the interest deductions relating to those loans. That will mean that a significant number of SMEs just don't have to worry about the thin cap rules anymore. So a really positive move for a lot of our small, medium-sized clients. Now, the flip side to that is that those clients who do exceed that $2 million threshold will find it much harder to pass the thin capitalisation rules. The thresholds and the ratios are going to be significantly tightened. So now's the time to be thinking about whether clients who currently need to consider the thin cap rules, will they now fall under the proposed new de minimis threshold? If not, are they going to have a problem under the thin cap rules that they maybe didn't have in the past, just through the tightening of the ratios? Now, the proposed changes are meant to take effect from 1 July 2014, so 2015 year will be the first income year that we'll see those changes really have practical impact. But now would be the time to start doing a bit of sense checking, just checking whether clients are likely to be impacted either on a positive basis or in a negative way as well. Now, tied up with those changes are also some amendments to the rules that currently apply where a foreign company pays a dividend back to an Australian holding company. In many instances, that dividend can be received tax-free in Australia, and that's through Section 23AJ of the 36 Act. The government's also planning to modernise the way those rules work. There's some quirks around the way that debt and equity interests are recognised and how the rules apply in that situation. One of the other things that the government's planning to change is to allow that exemption to apply even if shares in the foreign company are held by a trust or a partnership. At the moment, the rules don't really work where you've got an Australian company investing in a foreign company, but with a partnership or trust in between. So the rules are planned to be changed to allow that to happen and allow the exemption to flow through when the dividends come back to Australia. Again, we'll see how that actually works. Those things haven't been enacted yet, but that's certainly the plan from 1 July onwards.
In cases this month, Mike Carruthers looks at Yates versus the Commissioner of Taxation and the evidence required to claim GST credits.
Now, it's been a fairly quiet month when it comes to tax cases, but I thought you'd just give you an update on the Yates case. This was a case that went through the AAT and deals with a situation where the taxpayer was claiming input tax credits for expenses they were incurring in relation to their business. Now, the taxpayer claimed this broad range of expenses, claimed all the GST back. They lodged their activity statements on time, but the ATO did undertake an audit of those activity statements. And the ATO asked the taxpayer to produce evidence of the credits that they were claiming. Firstly, we get the impression that the taxpayer wasn't all that forthcoming with evidence, and then when they were, it wasn't the sort of evidence that the ATO was really looking for. The ATO basically disallowed a lot of the credits, and the matter went before the AAT. Now, basically what the AAT said was, when it comes to claiming GST credits, you generally need to hold a valid tax invoice. Now, that's something we generally know. We look for tax invoices when we're trying to substantiate clients' claims. But the AAT did recognise that there is authority to support the view that even if you don't have a valid tax invoice, you can still claim GST credits, but you do need to have sufficient evidence of the expenses that you're trying to claim. So in this case, the AAT said, well, had the taxpayer been able to show some evidence of who the payment was made to, firstly, and secondly, what exactly the payment related to, then they would have been happy to give them the credits. Unfortunately, in this case, the taxpayer wasn't able to produce sufficient evidence. It wasn't good enough evidence. So the AAT knocked back a lot of the GST credits that had been claimed. But I guess the positive thing is that just because you don't have that valid tax invoice doesn't mean you can't necessarily claim the credits, but you've got to have something else reasonably substantial to back it up. Now, the second part of this case deals with penalties. There was an argument over whether the taxpayer had been reckless or had simply failed to take reasonable care. Now, the scary thing is here that the AAT actually agreed with the Commissioner that this went beyond failure to take reasonable care, and the taxpayer had actually been reckless. They had claimed those input tax credits on a reckless basis, given that they just didn't have the documentation to back it up. So the end result was losing the GST credits, but also being hit with a 50% penalty on top of that for being reckless. So a bit of a warning out there, don't claim credits unless there's either a tax invoice or quite strong evidence to back up the claims being made.
And that's the tax roundup for June 2014. And it's almost the end of the financial year. And if you're not quite ready for that huge amount of change that's coming your way, then why not have a look at what Knowledge Shop has to offer? We'll manage a lot of those changes for you. We have a knowledge base of work papers, checklists, and things you need for the new financial year. On top of that, we have help desk support and also quarterly training. So have a chat to Ray, have a look at what we have to offer, and I'll look forward to seeing you in the membership. See you next month.